All guys can hear us okay. Um, Technology. I'm trying this technology for the first time, so hopefully we can deliver a fantastic webinar today. So, guys, you have always heard me saying that it's 70 to 80% is your mindset and 20 to 30% is strategy. What it means is mindset is basically you looking for a positive aspect in every challenge. You look at half glass full and finding out the opportunities when everyone else is going through a challenging time. That all only comes when you have the right mindset. And the strategy is all about having the right team around you on particular subject matter. For example, to become a successful property investor, you need to have a wonderful team around you, from having a good property strategist, a good accountant, a financial planner, quantity surveyor, property manager, insurance broker, and so on. List goes on. But you need to build those key partnerships to build a successful property portfolio. And today, we got one of the key person who makes the property investment successful, because in property investment and business, one thing matters most is numbers. And today we have Munzurul Khan is our dear friend and highly regarded accountant, principal of Keshav Chartered Accountants, who has joined to discuss everything related to property investment and accounting. With over 18 years of experience in the accounting industry, Munzurul Khan is highly regarded as one of Australia's thought leaders on property investing. So guys, today we will be discussing and covering few things. Number one, will be talk about Manzurul's experience and how we can benefit from Manzurul's experience, and also the reason for me to bring this webinar live was we were having a chat a couple of weeks back with Manzurul, and Manzurul said that this coming decade there is a prediction that the inflation might kick in into Australia. So there are pros and cons if that happens. So that's a subject we're going to discuss today, and also how to capitalize in the current property market and what might the market do next, so we can get prepared for that next opportunity. So, and also we have allocated some time for Q&A, and thank you everyone for sending so many wonderful questions. They are very insightful questions, and we will be asking Manzul. So stay tuned. So let's begin. Manzul, welcome to the show, and thank you so much for allocating your precious time to discuss about this key subject, which is very, very important in for an investor. So, Manzul, I know that you have been investing since 90s. That's been a long, long time ago, and during that time, you have seen probably high interest rates, different property market, sometimes market going every day, like right now, and sometimes market doesn't move for a long time; it becomes stagnant. But if you look at a property cycles, you probably have seen a couple of property cycles, and you have build a substantial property portfolio for him yourself as well. And Manzul, to be very honest, I haven't seen such an passionate accountant about property in my career. Uh, there are a lot of accountants who talks about numbers, but they are not passionate about property. So Manzul, I want to ask you that it's been around 30 odd years, I guess, since you started investing. So
That's right. Yeah.
what your learnings has been so far from your journey?
Thank you, Jack. Thank you. First of all, I do want to say thank you very much of this opportunity of having this open chat with yourself into this live forum as such. And thank you for inviting as well. But you were very, very, very generous with these sort of introductions. So again, thank you. Yeah. Jacka, I started investing back in 1999. So that was my very, very, very first property that I invested. As a career, I started about 96, and that was as an undergrad accountant. and then progressively along the way sort of moving through into smaller practice, larger practice on my own practice as such. The investment I started in 1999. Now, I must say that in day one, when I started in 1999, is that there were no knowledge, no understanding, and I didn't want to buy into properties. It was more of an inspiration, more of a direction from my father, is to say, no, you listen to me, you buy the first property. After that, you do everything else. I passionately argued, saying that no, that was not the right decision. Why would I buy property, right? And property has a whole lot of challenges, right? So you've got the hot water system and sort of the carpet and the tiles and the blinds. Do I really have time to go through all of those? And my father says, no, you start with a property investment. So that was back in 1999. And it has been a journey. I think if I look back into my first 5 years, 6 years, 7 years, I had no knowledge. I mean, I've learned about trust probably back in 2004, 2005 for the first time. Prior to that, I didn't know much about the family trust, discretionary trust, and positive and negative as such. And I look back to it now about 22 years of investments, yeah. And with that sort of 22, 23 years of investment, I look back and I say that, wow, I've seen so many cycles over that period of time. I suppose probably the first thing which I learned is that there is no one rule which sort of fits it all. So there is no one market. It's a market within market. There is no one cycle. It's cycle within cycle. And also when we speak with the property investment as a diversification, even from a diversification point of view, from the property investment, there is many sense of diversification that one can consider as well. So if we look back to the history, 1999, New South Wales, as an example, was doing very, very well at that point of time.
Was it a
Queens,
peak time, Manzul, when you started investing? Like a
it
growing
was
market or very
yes.
stagnant?
Yeah, it was a very growing market, but I probably would not dare suggest that it was the peak of the cycle in New South Wales in 1999. And, incidentally, at that stage, the interest rate was about 5.99%. And if we look through the interest rate side of it, I've seen that 5.99 going down a bit, about 4.5, and that's the standard rate that we pay. I've
Yeah,
seen it gone up all the way to about 8.5, and now we're sort of speaking about twos and threes. Now I
yeah,
speak to some of the elders, and these are the people who are sort of 80s and sort of late 80s, and they sort of say, well, you haven't seen 15 and 17 and 18, and I haven't. And they say that Munzurul, you haven't seen the inflation. So I hear and learn from them, yeah. But in my experience is that what I see from 1999 onward is that Sydney was on a growing phase. Sydney did very well for the first 2, 3, 4 years, and I'd probably dare suggest that 2003 was sort of seemed to be quite big in
peak
Sydney,
of the market.
and
Yes.
then Sydney stopped because the numbers sort of didn't make sense. And
Yeah.
Brisbane market seemed to have started doing very well between 2003, 2004, and did very well all the way up until 2008, 2009. And
Mm.
Sydney sort of did nothing. Melbourne did reasonably well within that period of time. Then I look back into Brisbane and I sort of say that, well, in 2008, 2009, Brisbane sort of started to seem very, very pricey. And Sydney market has started to go up a little bit, and Brisbane almost did nothing for about 4 or 5 years. Then in say 2012, 13, 14, it sort of did a little bit. And then in the last 4, 5, 6 years, we sort of see that Brisbane has almost done not a lot. It was stagnated market within that period of time, whereas Sydney sort of went up and down. So we look back and we sort of say that, well, the old saying, what we sort of say, that whether the prices double every 7 to 10 years. And we sort of always look back and say, does it happen? Can it happen on an ongoing basis? Can it happen over many period of cycle? And with many of my properties is that I look back and I say that it actually did do that. It did increase over period of time. It's about the consistency. It's about the persistency. It's about
Yeah.
staying into that market over a period of time. So the learning lesson, I suppose, that what I have taken personally is that it is always time in the market is sort of the first. And then if one can do the timing, we take that as a bit of bonus. but it's the time in the market, it's the time in the market, it's the time in the market. No one can ever do 100% exactly the timing. So the classic example is that when we had the COVID last year, we had all this prediction that there's a 25-30% drop of the
Exactly.
market is that we're expecting.
Yes.
And then we sort of look back and we sort of say that, well, now the prediction is that Sydney, New South Wales will have not only double digit growth, it probably will be anywhere between 20 plus percent growth this year. Now,
Yes.
in the middle of the COVID, if we were to make that as a prediction, it would be just silly,
That,
right?
that's
So,
right. I agree with that, Mansoor, because if you look at it, top economists like the financial institutes who spend so much money on research and predicting all this, they couldn't predict what's going to happen. So if we stay on the fence just that I want to buy on the perfect time never gonna come. So you are so right, Manzoor, it's a time in the market.
yeah, and then what we do, I suppose, is that that while we are in the time of the market, we still need to look through each transaction on its own. And this is by no means a financial planning advice at all. This is more from an accountant side of it. Is that when I purchase, I look into the facts and the figures, and I sort of say that, well, why am I buying it? So each property almost needs to have, in my mind, is a bit of a business case. That
Yes.
am I buying it because of growth? Am I buying it because of cash flow? What's the exit strategy? Do I see that as a buy, renovation, and sell? Do I see that as buy, renovation, as hold? Do I see that as buy and hold? Do I see that as a flip? Do I see that as a subdivision potential? Do I see that as a manufacturing growth? You know what? Do I see that as sort of a house with a granny flat, whether it's a house with a secondary property? There are many, 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 many different ways of doing it. So we can all look into the, I suppose, many option. But the question is, what is important to me? And as an investor, and that's not to me, Mansoor, as an investor, what's important to an investor?
Yeah.
And the investor may say that, well, you know what, it's the growth over a period of time which works out very well. So we like the growth. But at the same time, the investor may potentially say, well, you still need to maintain the cash flow, right? And if the cash flow is not being maintained, you can have all the growth potential, but whether it becomes a bit
Cash
of
is
a house
king.
of cards.
Cash is king in business or property portfolio, building a
That
property portfolio.
that's right, that's right. And whether it becomes a house of cards. Now, the other thing which I've learned over a period of time is that having the risk mitigation, and the risk mitigation in the sense that I always try to have a bit of buffer. And the buffer means that I sort of say that as a rule of thumb, if I sort of have a few months worth of expenses being set aside, means that if things goes wrong, that I've got those sort of the buffer. I always do a bit of maths in terms of the interest rate to be touch bit higher than the actual interest rate, and saying that, well, if it does increase, whether I can manage it. But if I look back and I sort of say the biggest learning lesson that I've heard over a period of time, there were lots of wins, there were a number of errors, but the biggest learning lesson is that I always did some action. And eventually what I found is that arguably many action, probably most of the actions are better than almost no action.
And Mansoor, throughout your journey, you've probably seen that market going up, and then there's always comes a time when market doesn't grow, and then all the media talking negative, and when you look at your portfolio as well, it's not growing as compared to when the market is growing. Have you ever got a doubt or a negative sentiment in your head and said that and how did you overcome that? If you came across that negative sentiment, how did you overcome that?
Good question. Very good question. But you started this whole webinar saying that a good portion of the success are in our mind. And I truly believe that yes, the strategies are important, actions are important, dreaming is important as well, believing is important. All of those things are important, but having the right bit of the mindset, right? So with my investment, I always started with an investment with a very long-term perspective, saying that I'll be holding it very long term, and it's a buy and hold for me over a period of time. And I've made a mental note saying that there would be short-term fluctuation. Market will go up a bit, market will go down a bit, but the question is, what does it do over a period of time? Patience is important, and also I suppose looking into that longer term view is very, very important. So I'll give you an example that the Brisbane market as an example that last 5, 6, 7 years that many of my investors who sort of bought it for last 5, 6, 7 years is that they said, well, Brisbane hasn't really done anywhere near as well that we've heard that it would be doing. And that's true. It hasn't. But then you still go back to the fundamental of it and say, well, the return seems to be pretty decent in Brisbane, and there is so many other things sort of infrastructure wise seems to be happening in Brisbane. COVID seems to have been managed reasonably well. So you add away all of those, and now you look back into the Olympic, and you sort of say that all the sort of the prospects are there. So if you look into the Brisbane market right now, it's pretty strong, very, 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 very strong. So I think having that sort of a longer mindset is very important, and not getting too sort of, I suppose, thrown away with day-to-day sort of a statistics. Yeah, it's a long
That's
game.
that's right. You don't invest into the property; you invest in your future.
That's right. And it's a long game, right? I mean,
Long-
property is an illiquid asset, and
Yeah,
you do it for a longer period of time. There is a buying cost, selling cost as such. So at a bare minimum, my view is that I put in at a bare minimum, say 10 to 15 years. And then if it's 10 to 15 years at a bare minimum, then any property at that point of time arguably will do reasonably well.
Manzul, I have been, watching, reading about property investment for a long time, and I've been investing since 2009.
Mm,
So yeah, it's been a decade now to see
mm,
that to see the journey. And what I have through my readings, that I got a story behind why Brisbane market didn't grow at the time it was supposed to grow. So
right.
if you look back into the history, uh, Brisbane always followed after Sydney. When
Mhm,
Sydney became unaffordable, people
mm,
started moving interstate,
mm,
and that's when the Brisbane market started going up because
mm,
business market Brisbane population is highly dependent on interstate population than on
mm,
international population.
mm,
So if I look back, when 2003-4 when Sydney market peaked, straight after Brisbane has its time, and then market really went well for next 4 years, and then we hit with the GFC, and then the all
mm,
over Australia market got stagnant,
mm,
and then we came back again. Sydney did very very well in till 2015,
mm,
till the peak, and after that it was slowly Brisbane's turn was supposed to come, but we got hit with Royal Commission.
mm,
So then the lending was all of a sudden become a challenge. So
mm,
people who wanted to move interstate and get the borrowing to purchase those properties, they couldn't borrow,
mm.
and that's the reason it has. And Brisbane market has been long due for a long time now,
Yeah.
including every economist in the country has been predicting in the last cycle as well Brisbane will go up, but it didn't go up unfortunately. But now looking at it, Brisbane has been the second uh, fastest growing city,
Mm.
apart from Sydney in property growth. Brisbane has done very very well in the last year.
Yeah, but I'm a strong believer of invisible hand. And what that effectively means is that the market always gets balanced out over a period of time, right? So if a particular market sort of doesn't grow as much, then what it does is that your rent sort of increases over a period of time, because rent is indifferent to the emotion in terms of the growth. Rent grows because purely because the population increases over a period of time, and population increases means that there is more demand and expectation with the rental, and the rent grows. And of course, with the CPI as well, the rent sort of grows. So while the rent grows and grows and grows over a period of time, is that if the prices don't grow, is that before you know, the investors start to look through and say that, well, hang on, the return seems to be a lot more decent. So what we saw in Brisbane, let's just say in 2008, 2009, of sort of 2.5%, 2.7% as a gross return. And then we look back now and we sort of say in 2019, 2020, it was very, very, very common to get anywhere between 5 plus, very common. And particularly when the interest rate is much lower and you're sort of speaking sub threes and sort of mid twos, is that if they're 5% return, it's sort of pretty positive cash flow. even if you take 100% of the loan. So the investors start to look through and say that, well, the returns make sense. If Sydney is sitting anywhere between, say, 3.5%, maybe touch bit higher as a gross return, of course, I'm generalizing. Each market has
Yeah.
a market within market. So if we say 3.5%, whereas Brisbane is sort of sitting about 5%, all of a sudden that makes sense. So what that means is that all of those group of people from Sydney, they start to go into the Brisbane side of it. So a lesson that I've also learned over a period of time is diversification. And diversification is not only in terms of the product, which are the property, diversification could be in terms of location as well. So in my case is that if the properties are in between Sydney, Brisbane, Melbourne, Western Australia, so more you sort of spread it without becoming too thin, more you sort of spread it means that irrespective of where the market is, you would have one market going up, and that effectively pulls all the rest of the market, and that market become quite sort of overpriced, and then this market starts to go up, and that sort of pulls the rest of the market, and the list goes on, right? So it sort of balances
I
out.
completely agree, Manzurul. That's why it's called a portfolio approach. I always think take a portfolio approach. Approach means not just looking at one investment property, looking at a
Mm,
whole portfolio. Because some
mm,
properties may not be doing at a particular time because that market may be stagnant, going through the stagnant time, and the
yeah.
other market could be growth time. So if you look at an overall portfolio, and then as long as your portfolio is moving slowly upward, yeah, you are fine, and you should stay positive all the time. And Manzrul, you mentioned one thing about the invisible growth, right?
And
Invisible number.
invisible hand,
I
yeah.
have a interesting philosophy
Sure.
on invisible.
And
I'm kind of a bit of a more spiritual, so I believe in invisible power a lot more. And when I mix that invisible powers and I try to bring it into property, I said, it's a invisible money. It's an
mm,
invisible money in property. I'll give you an example, Mansoor. And it's a perfect trade in day-to-day life. For example, if you buy a $500,000 property, and let's say if it doubles in 10 years, as we say, property doubles in 7 to 10 years. I have gone into the cycle of saying now 7 to 12 years. We need to have a bit more patience because property prices have already gone up quite high. So if I take 500,000 property and it doubles in 10 years and it becomes $1 million, you have made $500,000.
mm,
And if you don't believe in that invisible money, you would never invest in the first place. We are investing because we have to believe in that invisible money.
mm,
And if the property, let's say, it's costing these days, interest rates are ridiculously low. But if you take an average of 4-5% interest, because I always take on it, I'm also saying, Manzrul, I always put extra buffer when I'm doing
mhm,
calculations for my holding cost for my properties. And when you take let's say, even if a property is costing you $100 per week after tax
mm,
and cash flow, and if you're going to get $500,000 in 10 years, right, and divided by 10 years and divided by 52 weeks, it's $1,000. It's roughly $900 to $1,000 a week, right?
yeah. It- it's
And
about,
you
mm, you go.
and you are putting only $100 and you're getting $900 back, but that's invisible. If it was visible, everyone would do a trade.
Sure.
So guys, if you are listening on this podcast, if someone gives you 100, if you give $100 to someone and they give you back $500, would you do the trade? 100%.
Mm,
Everyone would do the trade. $100 give and I gave $500 back. But you have to believe in the invisible money to see that money growing in future. You won't get today, you get in the future, but you have to have patience and you have to go through a lot of challenges. But
yeah.
to go through challenges, you need to mitigate through proper strategy.
Yeah, you are absolutely right. I suppose, Jack, is that one needs to make sure that the cash flow is fine, and one needs to make sure that it's not too much negative cash flow while we are holding. What is the holding cost? Of course, there is a tax incentive against that holding cost as well that we take into account. Yeah, so one is to take some of those things into account as well. But you're right, it's the other people's money, so to speak. It's the bank's money, right? So
Yeah,
as long as one can manage that with the cost side of it, it's the compounding impact, which over a period of time, it grows and grows and grows and grows as long as one can manage it, the cash flow.
100%, Mansoor. every opportunity comes with a responsibility. So
Mm.
we have to be responsible for our own cash flow. And if you don't put those buffers aside, and when interest rate goes up, the same property which we love, we'll start hating it if we don't manage it properly.
Absolutely.
So, Mansul, let's jump into the topic. You and I were talking about, again, this is a
Mm.
prediction only, and I have also been reading a lot that inflation has hit America, US, and Australia generally follows US, and inflation goes up here as well. And what do you think about the inflation? See, I don't know if we can see numbers wise inflation gone up or not, but I can already see the prices going up. Woolworths. I don't know if everybody's shopping at Woolworths. They have already increased their prices, and the budget has already, your weekly cash flow would be a lot higher on outgoings now. So
Yeah.
what do you think? What would happen if inflation starts increasing? How would that affect the property market, and what are the pros and cons?
Beautiful. But the first comment which I want to say about inflation is that, believe it or not, many of us we haven't seen it in Australia. And the reason why we haven't seen it is that we're being so blessed as an exception of a nation, as a generation, that we haven't actually seen the inflation in over a generation. Yeah.
Yeah.
So I personally haven't also physically seen inflation. Inflation were your 80s and sort of early 90s were the inflation, right? So inflation can be a bit of a double-edged sword. It's both good and bad. Now, some people say inflation could be quite cancerous, and it can take away a lot of things. And some people sort of say that, well, if you can tame it to some extent, is that it could be an absolute your friend if you can tame it. Now, where are we with the inflation data? If we look through, is that the annualized inflation in June is about 3.8%, depending on which statistics that you see. The month of July by itself was about 2.1%. Now, if we analyze that, that's sort of quite silly and sort of out of, I suppose, quantum compared to, say, 3.8%.
Yeah.
So inflation, our target has always been between 2 to 3%. That's the Reserve Bank's target, is to leave it between 2 to 3, ideally leave it around 2-ish. You don't want the inflation to be too low. You
Hmm.
also don't want to be much lower than 2%, and you don't want it to be too higher than 3%. Now, Reserve Bank has this fundamental target, leave that between 2 to 3%. And they've done it, they've done it, they've done it, they've done it, they've done it exceptionally well so far. But once in a generation events that we are seeing at the moment as a generation is that, and none of us, we've seen this, right? I mean, we haven't seen the COVID. When was the last big pandemic, right? So you look into SARS and Bart's flu and you sort of say, well, those were little sort of pandemic. You got to really go back all the way to a Spanish flu. And then you got to go back to the plague, and there was generation and generation prior to it, right? So none of us, we have seen COVID oriented the impact as such. So inflation is, we all dreading that it is probably on the way. What happens in the world of inflation when it
Yeah.
does
Yeah.
is that if we look through from the business side of it, if we look through from the property investment side of it, if we look through from the entire economy side of it, the business side of it, your natural sort of the view is that the prices increases means that all the wages increase. So salaries and wages are expected to increase. If you look into the unemployment rate, is that the last unemployment rate I've seen is about 4.7% or so, right? And the full unemployment in Australia is sort of early fall. Because you will always have some people who sort of in between employment, maternity leave, paternity leave, and some level of leave, study leave, that they're sort of not in employment. So around that 4.1, 4.2 is sort of our full employment. So we're not very far from full employment at all. That by itself has a natural pull in terms of the wages. So the wages probably will increase. Now, all the rest of the plants and materials and equipments, they will all increase. So if you look into the housing side of it, is that you sort of say that you speak to any level of builders, and the builder sort of says that, well, we can't find timbers Timbers
Yes.
are a lot more dearer, and this is September that we're speaking, 2021. Timbers are a lot more dearer. They
Yes.
sort of say, well, gyprocs are a lot more dearer, steel a lot more dearer, right? Every single sort of a building material seems to be a lot more dearer
Yes.
because what we are receiving from overseas is that we're not receiving at a level that we wish to receive to, and our demand seems to be a bit high as well. So there is a gap in between what we need and what we have, and that sort of is increasing the price. So all of those sort of the prices increases from the construction that has to flow back in terms of somewhere. So
Yes.
your construction prices are increasing, means that naturally your house prices are increasing as such. With the inflation, if I think about it, is that people's wages are higher, or will be higher. And if the wage is going to be higher, that means they all on a sudden feel that they can afford quite a bit more. And if they can afford quite a bit more, means that they tend to borrow quite a bit more. And if they tend to borrow quite a bit more, means that they bid for a bit more. And that sort of also has a demand on the price side of it. So inflation means that your property prices are supposed to increase. Now, one of the winners of the inflation are arguably is people who are already an investors. And the reason behind it is that not necessarily your interest cost increases with the same rate. Now, whether there would be an RBA interest, whether there is banks outside the RBA interest, it's a complete different discussion. And to a great extent, whether it is relative to inflation or not, perhaps not. Yeah. So complete discussion. So if the wages increases, the prices increases, the interest rate are a lot lower, means that more and more people will be buying it. Yeah. So
Yes.
that's in one side that there is a price increase. The rents will also increase. Yeah.
Yeah.
And why the rents will increase? Exactly with the similar reason that all product, all commodity will have an increase. Now, where with as an investor we got to be careful is that yes, the interest, the prices increases, rent increases, which are all good news for us, right? As the existing investors, the new investor sort of says that, well, how do we sort of potentially move into the market early as we can? But where we got to be careful is that there is also a risk that the interest rate will increase at a particular point of time.
Yes.
Now, when will the interest rate increase? I mean, that by itself has been changing quite a bit. Before we had this New South Wales lockdown, is there was a general prediction with the economists towards the beginning of this calendar year that perhaps in September, October, November, December, November, that whether we see some upward increase of the interest, and there was a reasonable likelihood that it may. Now, while all the lockdowns sort of happened, what it did is that it just pushed through that sort of the increase of the interest rate bit further away. Now, is it March, June next year? Is it toward the end of next year? Some of the economists also suggesting that, well, perhaps it would be 2023 when it increases. Most of the economists are saying it is that the interest rate increase is perhaps it would be more out of cycle increase rather than the RBA as a step one. So what that means is that the individual banks would be a lot more incentivized to increase the interest rate first rather than RBA coming in. And RBA might come in at a point of time. You know, you speak about the Royal Commission and the APRA restrictions, and so there are some initial discussion that they may also come into effect as well. So there is a whole lot of unknowns that we sort of course, we don't know. We speak about the invisible hand. The other thing which we speak quite a bit with the economics is the butterfly effect. And the butterfly effect in the sense that as soon as you change one element of that entire sort of the longer sort of the effect, it sort of changes so rapidly is that the end result could be very, very different because of that sort of just one sort of a change. And I think that one change was the entire COVID. There are some statistics saying that if we didn't have the COVID, our average price in Australia would have been anywhere between 15% or lower than what we has at price, purely because that lower level of the interest rate sort of prolonged a bit longer. So, but eventually, Jack, is that the interest rate has to increase at a point of time,
Yeah.
eventually,
Yeah.
and it will increase. So the big question is that you would have a price appreciation in terms of property. You may also have some rent appreciation as well. You may also have some wages appreciation as well. But when you have that interest rate increase, is that whether we are ready and prepared for that interest rate increase. To give a very simple example, is
Yeah.
that the last about 10, 11 years that we actually didn't have any increase of the interest rate from RBI. So you've got a generation of investors who sort of investing where they're not used to of any increase of interest rate from RBA. And
Yes.
today's, let's say they're used to, nowadays, I was speaking to a gentleman, he's fixing his loan for 1.99%. And then it's very, very common of people fixing at 2.2, 2.3, 2.4. Let's even assume that 2.5 is the interest rate,
Yes.
right? You and I, we know with our investment that it doesn't take that long for the interest rate to go to 5%.
Yes.
But it's not so much the 5%. If the interest rate does go to that 5%, the standard variable rate from the bank after the discount, if it goes to 5%, it's actually double the repayment.
Yes.
So a gentleman who's buying a $1 million property, let's say as a loan, and paying $25,000 interest, all of a sudden, when that interest becomes 50 grand, it double means that he's got $25,000 extra interest rate that he's sort of paying. The question is his wages are going to be high enough, or his rental increases are going to be high enough so that the increase from the wages as well as the rental subsidize that increase of the interest rate, and which side of the equation would be higher.
Yes.
So my personal view is that in this world of inflation or potentially inflation coming in, that perhaps we need to invest with a little bit more caution, with a little bit more buffer into our hand, and saying that, well, we will assume that the interest rate increase. The reality of it is that there would be some of the investors that they might struggle at that point of time. And one might suggest is that there would be some influx of properties coming in with some level of opportunities. And the question is that an ideal investor, an absolute win-win investor would be an investor who can go through that entire increase of inflation with the price increase, and at the same time also take the opportunity where some of those properties comes back into the market with some level of a struggle, whether they can purchase that with the right level of price.
Yes.
So the whole pot becomes compounding effect.
100% Mansoor. And it's all about preparing for this opportunity, right? Either we can get scared and sit back, but I see a massive advantage if you are ready. There's always an opportunity during a challenge. But how can we maximize that? We can start investing earlier on, but on top of that, have some buffers aside. And we are only talking about investors here, but there are a lot of mom and dad who are investing. They're buying their own home and upgrading to and that I call it a bad debt. We all need a home, but sometimes we go beyond our limits and go for a that don't just I have to catch up with my friend mentality. I think that would be a more challenging, and that's where the opportunity will lie in future. Uh,
Yeah.
but for investor, at least they can claim all the tax deductions, all the interest. If they go up, they claim back in the tax benefits.
And that's what it did. Like when the inflation happened around that sort of 80s and so, right, there is a group of people who are rich, they become a lot richer. But there is also a group of people who struggle a lot more, right?
Hmm.
And that bit probably will be the same, that whether the gap between the rich and the poor, whether it increases. The COVID did do that, right? The COVID increased the gap between the rich and the poor. Do we have much say into it? Probably not, because it's the economy that we just need to follow. But what we do have a say, and this is important, is that we try our desperate best so we stay on the right side of the equation with the
Yes.
full informed knowledge. And that full informed knowledge is that when your investor sort of buys the principal place of residence, goes up there, does the renovation upgrades, and do all of those, as long as we do it in a very informed manner,
Yeah.
knowing that, okay, this is what the cost is, as long as we do with some mitigation factor, saying that, well, if there is a one job that perhaps doesn't stay there for a period of time, and all the costs sort of increases, we just have that 7 grand sort of a roof repairs, and whether we can subsidize all of those, not rely too much on the tax benefit, because the tax benefit, we always take that as a bonus, as long as all those mitigations are there. So the whole exercise, if I may, it becomes an exercise of science. So it's a very informed decision.
Yeah. You have to be in it to win it. So
Yes,
start
right,
investing.
right.
Mansoor, we're getting heaps of questions from our audience, and maybe it's time to start bringing out some questions for you. They are there are some really interesting questions out there related to accounting and property.
Yeah.
So let's me bring on the first one here. Um, all right, I got the first question here for you, Mansul.
Hmm.
Um, I won't mention anybody's name just for privacy. I'll just read the
Sure.
questions for you. Um, I am an IT contractor. I have now set up a company and have an ABN, but wife is still PAYG. Should I purchase in our personal name or should I purchase in my business name? What will have the most tax benefit?
Yeah, good question, Jack. Good question. Look, the question that we sort of probably hear on day in day out basis, that do I buy it on my name, his name? Do I buy it on her name? Do I buy it on a corporate entity? Do I buy it on a trust? Whether it's a self-managed super fund, where do we buy? We always sort of say that we cannot give the financial planning advice. It's not a financial planning advice, but as an accountant, what we say is that we say that what are the pros and cons of buying it on each individual name.
Yes,
So if we buy it on his name, what are the benefits? If we buy it on her name, what are the benefits? If we buy it on company's name, what are the benefits? What are the negatives? Once you are informed with all the positive and negative with all of those, then you make an informed decision that where it is. And you know what? Based on whether it's a property one or a property two, property one could very well be on his name, right property, or property two could very well be on her name as a right property. To give you an example, let's just say husband and wife, and let's assume that the wife's income is a lot higher than the gentleman, right?
yes,
And if the wife's income is a lot higher than the gentleman, and if it's a property that which has significant negative gearing, lots of a newer property, and you're buying it for a very long buy and hold, then there may be an argument to consider whether we buy it on her name because she's at a higher marginal rate and the tax benefit is higher.
yes,
If you have a property which has got a granny flat and it's sort of break even if not positive cash flow, then we sort of say do we buy it on his name, because on this example whether his income is a bit lower than her name, do we buy it on his name, right? Now, do we buy it on a company? If it's a trading entity, perhaps an operating entity, then one suggests that perhaps may not be the right structure because you don't want to be bringing in the risk as well as the asset on the same vehicle. But the long answer is to that question is that while it is a very good question, you must ask that question every time with your accountant to run through before you sign a contract, because each contract, each property varies a bit.
sure, Mansoor. And Mansoor, just on top of that, you also talk about diversification into different state and buying under individual names uh, because of the land tax implication. Can you talk more about that land
Yeah,
tax?
yeah. Good question. Land tax varies on a state by state basis, right? So New South Wales, as an example, got 730 odd grand land tax threshold. Queensland, as an example, has got 600 odd grand land tax threshold on individual name. Trust has got 350. New South Wales has got no trust as a threshold, and same as Victoria has different threshold. So you also potentially bring in the land tax as part of the consideration, in the sense that, well, let's just say that I've got enough number of properties in New South Wales where I'm already over the threshold, or very close to threshold, and let's just say my wife doesn't have much of properties in New South Wales. The next property that I buy is that I need to take into account that land tax is 1.6% of the Governor General's valuation of the unimproved value of the land.
Yeah.
So one needs to take that account. And the question is that, do I save that 1.6%? That definitely becomes part of the consideration. It's part of the entire bigger puzzle in terms of diversification, in terms of tax benefit, in terms of longer term asset protection, in terms of longer term exit plan, and the land tax becomes part of it. And the final decision, in my view, is to consider all of those and where is the balance is sort of more being tweaked to.
And Mansoor, is it land tax is on individual basis? If you know,
Yeah, so
any-
each state is different. In New South Wales, as an example, is that land tax is on individual, that threshold. But if you buy it on a joint name, then the Office of State Revenue considers it's a partnership. And while a partnership, rather than having two threshold, one is for his and one is for her, you get one threshold. Yeah. So that's why probably land tax perspective is that the view is that perhaps we try not to buy it on joint name. The loan could be on joint name, but the title perhaps should not be.
great, great. Let's bring on the another question here, and there we go. What are the ways to minimize capital gain tax? Can I sell an investment in the future and use some of the profits from my sale to make an additional contribution to my super and reduce my tax? How much is that amount?
Yeah, look, the how do we look into the capital gain tax side of it? The first comment which I say is that there is a provision that if you hold it for more than 12 months, you get a 50% discount. So if the asset is being owned more than 12 months, you do that, right? So that could be a consideration that whether you hold it. Now, also to make sure that your accountant takes into account of all the cost base correctly. That means all the purchase related cost that the accountants takes into account, the stamp duty, solicitor's cost, as well as the selling cost, the agent's fee, and everything else being taken into account. All of those, your depreciation needs to be added back in terms of the capital gain tax side of it. So whether that calculation is being done in the right way, whether you hold it for 12 months or longer, any level of renovation that you've done along the way, that perhaps whether that can be added back as part of the cost base. All of those things that you do take into account, right? Now, let's say that if you do make some significant capital gain, do you have some losses from the prior year or existing year that perhaps you can utilize? If there are some losses, then you can utilize those losses as well against the capital gain. So that being taken into account. Now, the next thing which is being taken into account is that a whole lot of other deduction one can consider, and superannuation is a consideration. Yeah.
Yeah.
So generally speaking, is that you've got a limitation to maximum super contribution. Used to be about 25 grand, now it's about 27,500. So you can do up to 27,500, whether it's a salary sacrifice or whether it's a personal deductible super contribution, provided that the trustee of the super fund allows to do it. Now, once you do that sort of a super fund contribution, you get that benefit. How much you get the benefit, Jack, is that it all comes back on your marginal rate. So
Mm.
if you are sitting at the highest marginal rate, then you get the benefit at that highest marginal rate of that super contribution. So it's a good strategy, but you must discuss again with your accountant, remembering that the fund which goes into the super fund, that it stays in the super fund with the sole purpose of your retirement goal and until the retirement age. So it's also that flexibility and accessibility of the fund needs to be taken into account as well.
That was a good question. Um, let's bring on the another one here. Do I get more non-cash tax deductions from a newer property or an older property?
I suppose the question is that more in terms of the depreciation side of it, right?
Yeah.
And the depreciation in the sense that it's sort of the newer properties are expected to have a little bit more depreciation. Now the rules have changed. Previously, you used to claim the building depreciation as well as plants and equipments, but now you can only claim the plants and equipments if it's a brand new, right? And absolute brand new. If it's a bit of a second-hand, couple of years old, then you still can't claim the plants and equipments, right? But the building depreciation is still claimed, which is 2.5% that you can claim it over a period of time. So the answer is that yes, newer property, generally speaking, is that tend to have a lot more depreciation. But you know what? It could be an older property that it's whether it's a new renovation being done and whether that renovation can be passed. But generally speaking, the newer properties definitely have a lot more depreciation.
A lot more depreciation and claims. Yeah. Awesome. And let's bring on the another one. Can I buy a property in trust or company structure and offset the expenses, deductions with personal income if I'm in a PAYG structure?
No, because the each entity is a separate legal entity, so your losses in company and trust needs to stay in your losses in company and trust. They can be rolled forward and roll over and carried forward forever, but they cannot be utilized against the personal PAYG. Your salaries and wages, your personal PAYG is personal. If there are losses on a personal name because you own the property on personal name, then of course you can. But the losses on the trust and the losses on the company, again, generally speaking, can only be utilized against the future income an applicable level of income from the trust and company.
Yep. Thank you, Manzul. Was a good try, but unfortunately, Manzul said no.
Sorry.
So
Sorry.
let's bring on another one.
Mm.
Um, for people who require better cash flow on a weekly basis and own an investment or two, is it beneficial to have a tax variation form? Can you explain what that is and pros and cons?
Yes, it's the PYG withholding variation, as they call it.
Mhm.
I think previously used to call Section 221D or so, right? So PYG withholding variation, what that basically means is to go back to the commissioner and nominate saying that, well, I made an estimate saying that I'm supposed to get, let's just say 10 grand as a refund. And rather than me receiving 10 grand, 10,400 as a refund, what I would like to do is that I would like to get $200 refund per week, and you need to submit that almost a forecast of your tax return, and that forecast will say, here's my salaries and wages for the next 12 months, and here are the sort of the income and expenses that I'm sort of expecting over that period of time, and that's the level of the benefit that we sort of expecting. So that sort of is being forecasted, right? Now, the positive, I suppose, is that yes, you get a little bit of benefit along the way, and that sort of helps you on an ongoing basis if that is required. The constraint, though, to some extent, is that one got to be a bit careful, because what the commissioner says is that you are entitled to do a PYG withholding variation, but when you actually go ahead and do the tax return at the end, that tax return, it should not be very different to what your estimate is. That means you need to do the estimate with the best possible knowledge and not being too much out. And if you're being too much out in reality of it, then the commissioner has got the right to charge penalty and interest as such, right? So that's the bit that we got to be a bit careful. The other thing we also take into account is that it's sort of not a free money, in the sense that it is a refund that you're breaking it down. On a personal basis, is that many of my investors client, they sort of says that, well, receiving that 10,400 as one off, whether the impact of this is higher as opposed to receiving, say, $200 per week, because sometimes that gets spent on a day in, day out basis. The other question that I received some from number of my investors saying that, well, if I really have to rely on that example of that $200 per week, and to rely on sort of my investment to continue, does that mean that I've stretched myself too far?
Mm,
And whether I did. So the good investors, the prudent investors, have found very often is that even though they can do POIG withholding variation, they very often say that let's leave that at the end,
yeah.
and let's consider what it is, right? And the likelihood of getting it 100% right. I mean, there's so many things can be different in future. Yeah.
Yes. Yeah. I just see it as forced savings. If you can
Yeah,
save, it's a forced saving, and if you can get end of the year.
that's right. I agree.
Awesome, Manzul. I think we got a few more questions left, and I got another one here. What is the benefit of buying property in a trust company um, versus in personal name? Have for people who work normal PAYG jobs in trust really that necessary?
Yeah, good question. Whether trust is really not a trust and corporate entity, whether it's really necessary, it's more of a question of, to a great extent, individual circumstances as well. Your risk profile, your sort of the, I suppose, the longer term asset lifespan, and many others. Yeah.
Yeah, yeah,
So the trust, the benefit is that one argues that there are some asset protection with the trust because you don't own it, you control it. Trust also, one argues that there are some flexibility in terms of distribution between the beneficiaries, and the beneficiaries could be the primary beneficiaries, as well as brother, sister, nephew, niece, uncle, aunt, parents, grandparents, kid, grandkids. So, or any other entity that you've got control and ownership. So it could be very extended, the definition of the distribution, right? Very, very, very extended. So that's the flexibility. Negative of a trust is that in New South Wales, as an example, there is no land tax threshold. You pay it from dollar one. Many of the state, you pay land tax lot higher than individual. Negative is also of a trust is that you the losses that you have on a trust, if there are some losses from a tax side of it, those losses, as we spoke, you cannot utilize it against your individual name. You got to carry forward that for future use. And there is a setup cost, there is a running cost. Yeah. And what you do is that you balance it out in between the setup cost, running cost, the losses to be carried forward, a little bit of more land tax that you pay, and compare that with the asset protection and also tax flexibility. And the question is, which side is heavier? So I've sort of found from my experiences that many of the investors, they generally tend to start individually initially, where they buy a few properties on their own and initially live it nice and simple. As time goes on and things start to become a little bit more sophisticated, this is where the investors start to invest on trust, but probably not in the early days.
Yeah. You always have to, compare the benefit versus, what are the costs you have to pay for
Yeah.
it. And that's a very good advice, Manzul, because being an accountant, you would make more money if you set up the trust, but you don't want.
We do, right, and profitable and sort of not one off as an ongoing, but every time when we sit down with our client, our objective is that what is the right thing from the client's perspective. We actually don't even make the decision. Our role is to give the positive and the negative, and what we do is that once we go through with the positive and the negative, is that we go back to the client saying that what suits you the best,
Yeah,
right, and this is where the client makes the decision.
that's what I love about you, Manzul. You're very, very genuine, and you leave it to the people to make a decision, but you
Thank,
give always pros and cons.
thank you.
That's fantastic. Let's bring on another question here. And I'm a property investor from India from last 3 decades and recently migrated to Australia.
Mm.
What three suggestions can you share from your experience?
Wow. It has to be three, right? It can't be two or four. Okay. So
Yeah,
what are the recommendation that we can suggest? Look, the first comment which we say is that if you're an Australian resident, from a tax wise, very different from an immigration point of view, right? You could be an immigrant, is still non-resident, and non-immigrant but tax resident. If you're an Australian resident from a tax wise, your worldwide income must be disclosed in Australia at the Australian rate of the income and expenses in the Australian year, July to June. So that's probably the first thing that I say. It's all about the disclosure in the right way.
yeah,
Second thing, what we say is that you also need to be aware quite a bit in terms of the CGT impact. Because when someone becomes a resident, there are some provisions in terms of deemed CGT events that you need very specialized advice in terms of the deemed CGT events. And particularly over time when you do sell it, is that all the capital gains, if there are capital gains, they all need to be articulated in Australia. Yeah. So
yeah,
that's also important. So I've got two. The third one that the gentleman wanted is that you got to look through from the finance side of it as well. Is that from the banking side of it, my understanding is that if you go through, you got to disclose all of your worldwide level of obligation as such. So if you have lots of debts against those Indian assets, they might have a hampering effect against Australia. On
yeah,
the contrary to it, is that if there is no debts, Australian sort of banks, generally speaking, is that they tend to sort of say that, look, we will try to ignore them as much as we can because the banks are a conservative basis. So you may find that equity raising from those properties to utilize in Australia through any Australian bank could be a little bit harder. So anytime when you have this cross-border sort of a transaction, is that not only that the disclosure accountability is a lot more, complexity is also a lot more as well.
yep. And the fourth one is if you can get the lending, invest in Australia. It's a beautiful country.
Sure.
And
Mm.
I think we got few more questions left.
Sure.
Um, wow, it's already been an hour, Manzul. We've been talking.
Beautiful.
So there's been a lot of talk lately about potentially scraping stamp duty in favor of an annual land tax,
Yeah.
which would be assessed on a property's land value. Do you think it's a good idea to give people the right to choose either paying stamp duty, which is one lump sum upfront, or land tax, which would be an ongoing annual cost?
Good question. I suppose whether it's a political question and political question whether it's a better or not. But what I do take into account is that the benefit of potentially providing on a yearly basis as opposed to upfront is that you take away a lot of entry barrier. So a significant of the barrier is the initial deposit plus incidental cost, right? So we generally speak, and we sort of say that give or take is about, as a rule of thumb, we sort of say 5% of the incidental cost. And if we take away some of the system duties, and so you save that 5% incidental, so people can get into the market a little bit more. And also is that you would start seeing a whole lot of things such as like your those buy renovate sell sort of becomes a lot more practical. And why they become a lot more practical? Because entry cost is a lot lower. So I fear that what that will do is that that will create quite a bit of an upward pull in demand in terms of the price side of it, simply because it makes it a lot more accessibility. Now, there were some numbers being done behind it, and the number sort of says that even though as an investor you would be winning initially of going on a year in, year out basis, but there is actually a threshold. And after that threshold, you actually lose a lot more of being on an ongoing basis as opposed to paying it as a one off.
Yeah.
And that bit of the threshold, it depends on the price, it depends on where it is, but it's about 8, 9 years or so that after that it becomes sort of less effective. Now, then you sort of challenge that and saying that, well, the average investor sort of doesn't hold the property forever as well. They also buy and sell. So if we buy and sell within that 7, 8 years or so, then arguably we would be quite benefited. Yeah. So this will have an impact in terms of the price side of it. The question is, Jack, do we need it in a market where the market is so strong at the moment? Is a valid question. The question that I also ask is that how tempted the government would be not to give away all of those stamp duties, particularly in an upswinging market when the market is out of control. So I don't know.
Manzul, when these type of topics come, I always think just wait and watch. We can comment anything we want to, but nothing gonna happen. So let's
Yeah,
wait and watch what happens.
yeah.
But my personal opinion is, it's a give and take relationship. If you
Mm,
take something, you have to pay back long term. So if you get tempted now, yes, you have to pay the price back later.
yeah, yeah, yeah.
So we are just running, time is a constraint. So I'm not going to take more than maybe two or three questions, Manzul, and
Okay,
then we can wind up.
okay.
So let's bring on another question. Um, do you have any accounting advice for the parents whose children are coming of age of earning and starting their investment journey?
Well, look, my comment would be a good question. My comment would be is that perhaps it's sort of the question of that: do we teach someone how to fish, or do we try to give someone lots of fishes? Because lots of fishes still run out at a point of time. But if we do somehow teach young minds how to fish, that bit of the learning stays and stays and stays and stays and stays there. So what I would probably do with my son, he's turning age of 18 next year, is that as soon as he turns 18, is that I'll try to take him into many of those, I suppose, seminars and forums and sort of staying them as a shadow. So he can learn, he can learn, he can learn, he can learn. And I think that is the best bit of things that you can do. There is so much knowledge at the moment in the open world, and many of them are free knowledge, right? You just go into some of those podcasts, you go into some of the forums, encourage your kids to do it. While we do always sort of say longer term investments, sooner you get into the market, arguably is better because of the compounding impact. But at the same time, you also want the kids' experience to be a pleasant experience. So you don't also want to rush into them in forcing them in do this investment, do that investment, do this investment. Let them do the investment on their own way. And I think as a parent, we just try to give them as much education and just once in a while, just knuckle that a bit, my view.
That's fantastic, Mansoor, because you also started investing because your parents encouraged you to
Yeah,
start investing, and look at that, how blessed you are now because of that last little bit of push from the parents and
that's
putting
right.
you into the right direction.
That's
And I think if kids can start early with the encouragement and especially if they educate themselves, then they would love to invest by themselves rather than
Mm,
getting pushed by the parents. So education, education, education is the key.
I agree.
All right, last couple of questions now,
Mm.
Manzul. Uh, how can business owners maximize their lending when accountants help them lower their taxable income generally?
Look, the accountants should be based on facts and figures, right? So the accountants should be doing the return on the basis of what the numbers are. And the numbers are where the numbers are, right?
Yes.
But what you can do is that very often it's a bit of a storytelling to the bank, and storytelling in the sense is that you could have a set of accounts on the business, but there could be a whole lot of extraordinary things that you add that away. And those extraordinary things could be, as an example, that you've got non-cash items such as depreciation, amortization, that you can add that back. There could be a one-off expenses. Let's just say you've got a relocation. You went from one to different place, and you don't relocate every year, so that could be added back. There could be one-off recruitments, as an example, that you've done as a talent acquisition, and that could be 50 odd grand, and you add back all of those. So a right accountant, what it does is that very often is to identify some of those one-off and sort of present it to the bank in the right way. Very often also the storytelling, in the sense that you could have lots of different businesses, as an example, rather than just sending a whole bunch of set of accounts, tax returns everywhere floating, is that if you consolidate in the right way and say that, well, this is my true real income is,
Mm.
and on the basis of that true real income is that is what I can afford. I believe you as a bank, is that if you disagree, tell me why do you disagree. So I think it's the right accountant of taking that proactive approach, where presenting in the right way, as opposed to the reactive approach saying that here is the set of accounts. That makes a big difference. Experience comes in. Yeah.
Agree, Manzul. And I believe they're also good accountant and good finance specialist who understand how to present the case and take all those deduction into consideration would also help.
Yeah.
So, so have a good accountant and good property finance strategist in your team.
It does. And the experience and the right team. Yeah,
Yeah.
definitely.
Manzul, this is the last question, and then we can wind up.
Sure.
Um, what is the best way for a family to safeguard against hyperinflation?
We've been hearing about this hyperinflation. What is
Okay.
this hyperinflation, right? We spoke about the inflation, now we speak about the hyperinflation. Hyperinflation is sort of your exponential increase of the inflation, and how do we do it? Look, again, it's the risk mitigation, right? It's in terms of having your cash buffer, in terms of having your safety buffer, in my view, that over a period of time that we can, doing your calculation in a way that, well, if the interest rate sort of increases over a period of time, can I still afford it? Doing a math saying that, well, for whatever reason, that rather than having two salaries and wages, we have to live with one salaries and wages for a period of time. Can we also leave that as well? So it's about all of those sort of a risk mitigation that one must take into account.
That's great, Manzul. Thank you so much. That's all. I think we'll stop taking more questions now because it's everyone. I'm getting some great, without mentioning name, great advice, guys. Thank you for listening and watching us. And Manzul, thank you very much for
Thank you.
coming today and sharing your decades of knowledge and helping the right investor to start into the journey. Now, guys, before we sign off, I just want to tell you, if you have more questions, please, we are offering a free virtual coffee with our consultants. You can see the banner on the screen. If you can go up there, and you can book a free slot for yourself with one of our consultants. It's www.jrprosperity.com.au/coffee. It's a virtual coffee. So what happens is, if you will just give it a free discovery session, and after that we'll send you a coffee voucher which you can use at several places. So thank you for joining, everyone. Thank you, Manzrul.
Thank you very much. Thank you
Speak to
very
you
much.
soon.
Thank you.
Bye for now.